The thing almost nobody in finance wants ordinary people to fully understand is very simple. The bank does not exist to make your money work for you. The bank exists to make your money work for the bank. That is not a moral accusation. That is the business model. And the moment a person truly understands that, not just nods along to it, not just repeats it at a dinner table, but actually understands it, his whole relationship with capital changes. I have watched people spend 30 and 40 years moving money through institutions. They never really studied. Paychecks come in, mortgage payments go out, car payments go out, credit card interest goes out, business loan interest goes out, savings sit still. Retirement accounts remain untouched but misunderstood. And the whole time they believe they are participating in finance, when in truth they are mostly participating in someone else's financial system. Then they reach old age and wonder why the arithmetic never quite became freedom. That question does not come from stupidity. It comes from architecture. Most people never built one. That is the mother line of this whole story. Wealthy people do not just own more assets. They keep capital moving inside systems. They control. So the interest, the spread, the leverage, and the tax advantages stay inside their own world instead of leaking out to institutions at every turn. That is what it means to be your own bank. Not burying cash in the backyard. Not declaring war on every lender in America. Not pretending banks are unnecessary. It means learning to build private financial infrastructure around your life so that capital circulates under your rules more often than under theirs. I want you to hold one image in your mind while I walk through this. Think of a river money flows in, money flows out. Your salary, your business income, your expenses, your mortgages, your investments, your taxes, your borrowing, your repayments, all of it is water moving. Now think of the bank as a dam built across that river. Every time money passes through, the bank takes something, interest fees, spread control, approval power, optionality. The money moves. Yes, but the infrastructure belongs to someone else. That is the arrangement most people spend their entire lives inside. Now the wealthy ask a different question. What if I built parts of my own dam, not to stop the river? That would be foolish. Money must move, but to redirect more of it, to let the same dollar serve more than one purpose, to let interest come back to me, to let leverage stay inside my system, to let taxes work with me when the law permits it, instead of only against me when I fail to study it. That is the logic, not magic logic. And when logic is applied patiently year after year, it does things that look almost magical to people who never learned the machinery. The source organizes this around 3 serious ways to do it, and I think the structure is exactly right. The first tool is the one everybody thinks they understand and almost everybody gets wrong. The second tool is so ordinary it gets ignored even though the mechanics are extraordinary when used correctly. The third tool is where things become genuinely sophisticated because now you are not just borrowing better, you are building a private credit structure between entities you control. Then, near the end, the source adds 2 extensions that belong in the same family of thought: a home equity line and a securities-backed line of credit. Different tools. Same principle. Control the capital flow. Keep the spread if you can. Pay strangers only when the stranger genuinely adds something you cannot replicate yourself. That is the game. So let us begin with the first tool, permanent life insurance used as a banking structure. Now I know exactly what happens in the mind of many sensible people. The second they hear the words life insurance, they flinch, and they have good reason. Life insurance has a bad reputation because for decades it was sold badly, framed badly, overcommissioned, and aimed at the wrong people for the wrong reasons. Too many policies were designed to enrich the agent, not the owner. Too many buyers were sold a vague dream instead of a structure. Too many people were handed a death benefit story when what they actually needed, if they needed the policy at all, was a cash value structure that had been engineered with discipline. So let me clean up the confusion immediately. I am not talking about term insurance. I am not talking about buying a giant death benefit because somebody frightened you with family protection imagery and then quietly buried the real economics in the illustration. I am talking about a permanent policy that is intentionally overfunded so that the excess premium accumulates as cash value. That distinction matters enormously. Because once the policy is built around cash value rather than around maximizing the insurance component, the tool starts behaving very differently. Federal tax law explicitly recognizes properly structured permanent life insurance and gives it favorable treatment when it is built and used correctly. The source emphasizes this point because many people treat the whole idea as though it were some gray area trick. It is not. The legal architecture exists. The problem is not legality. The problem is that most buyers never understand how the structure should be designed in the first place. Fayfalicite Fayturn 63, File 0 Fay here is the simple version. You buy a permanent life insurance policy. Whole life or indexed universal life are the forms the source is mainly discussing. You put more into it than the bare minimum cost of the insurance protection. That extra money does not vanish. It builds inside the policy as cash value. That cash value then grows according to the design of the contract, either through dividend participation inside a whole life structure or through an index-linked crediting mechanism inside an indexed universal life structure. Now, if that were all it did, the tool would still be interesting but not revolutionary. The part that changes everything is what happens next. You can borrow against the cash value, not withdraw it, borrow against it. That distinction is the whole engine, because when you borrow against it, the internal cash value does not disappear in the same way it would if you had simply liquidated an account. You now have loan proceeds in your hand, and depending on the policy design, the internal value can continue receiving growth credits while the loan remains outstanding. That is the point where most people stop and say that sounds too good. Fine, let us make it less abstract. Suppose your policy has accumulated $200,000 of cash value. Suppose that value is earning around 7% internally over time. Now suppose you borrow $120,000 against it at roughly a 4% policy loan rate and use that $120,000 to make another investment, say a real estate deal or some other opportunity yielding 12%. You are now earning inside the policy and deploying outside the policy at the same time, while paying a loan cost materially below the outside return. That spread is the point. The source gives this exact kind of example because it wants you to see the thing the way a banker sees it. Not as an emotional product, as infrastructure, the internal reservoir remains. The external money goes to work, the policy handles the collateral, the death benefit ultimately resolves the loan at death if it remains outstanding. And the money moved without you going to a bank, begging a committee, filling out paperwork for an institution whose first instinct is always to price the transaction in its favor. Fayfalicite Fayturn 63 File 0 Fay, that is the power. No loan committee in the ordinary sense, no credit check in the ordinary sense. No stranger deciding whether your own momentum is good enough to be rented back to you. That is what people are paying for when they build the structure properly. Control, not fantasy control. Now, because this tool is real, it is also widely abused. That is where I want to slow down and become very blunt. The sales incentives inside life insurance are often directly misaligned with the buyer's objective. The agent gets paid more for larger death benefits. Larger death benefits consume more premium in the insurance cost layer. The more premium consumed there, the less goes toward building efficient early cash value. That means the structure the buyer needs if he wants a banking tool is often the opposite of the structure the salesperson prefers if the salesperson is optimizing commission. That is the first thing I would tell any adult considering this path. Do not listen to the person who leads with the death benefit. If your actual objective is private banking utility, lead with the cash value, lead with the surrender schedule, lead with the internal rate of return on cash value, lead with the loan terms. Lead with how quickly the structure becomes useful rather than how theatrically large the eventual death benefit sounds, because if you put in $50,000 and discover that the policy surrender value is dramatically below that in year one, you need to know where that gap went. The source says it bluntly, that gap often went to somebody as commission. And if the early years are too punitive, then the policy was designed for the seller before it was designed for you. Fayfalicite Fayturn 63 File 0 Fay, that does not make all such policies bad. It means design is everything. The right professional here is not a performer with a rehearsed pitch. The right professional is someone who can show you multiple policy illustrations, explain the cash value build properly, and is willing to minimize the death benefit drag to the lowest legal level consistent with preserving the tax advantages. That is the adult conversation. Not, look how much your family gets if you die. More like, show me the internal mechanics and prove to me this is being built as a capital control tool rather than a commission event. That is the first tool used correctly. A long-term wealth engine used carelessly. An expensive lesson in how incentives really work. Now let us move to the second tool, borrowing from your 401k or from the equivalent employer, sponsored retirement plan that allows loans. This is where the average person's instincts are usually badly trained. because he hears one phrase his whole life. Do not touch your retirement. That phrase is mostly useful as a defense against stupidity. It is not the full truth. A withdrawal is one thing, a loan is another thing entirely. The source is right to insist on this distinction because most people collapse them into one emotional category and then never learn the mechanics. A withdrawal usually is a mess, taxes, penalties if you are too young, permanent damage to the account, potential destruction of compounding. That is what most people correctly fear. A loan is not the same creature. A plan loan allows you to borrow from your own retirement balance under specific legal rules without the loan proceeds being treated as a taxable distribution at the time of borrowing. That is the breakthrough. The money does not leave the retirement universe in the same way a withdrawal does. It moves, it leaves the account and comes into your hands as borrowed capital, but it remains governed by a repayment structure rather than by the one-way consequences of a distribution. Most plans that allow loans let you borrow the lesser of $50,000 or 50% of your vested balance according to the source, and usually require repayment over roughly 5 years. The interest rate tends to float around the applicable federal rate, something like 4% to 4.5% in the source S framing, and the crucial point is this: you pay that interest back to yourself, not to a bank. Fay Felicite Fay Turn 63 File 0 Fay, that is the entire reason the tool matters. Again, not magic logic. Suppose you have $200,000 in your 401k. Suppose you need $50,000 for a down payment on an investment property or to wipe out a pile of credit card debt charging 22%. If you borrow $50,000 from the plan at 4.5%, then in one sense, yes, you are paying interest, but you are paying it into your own retirement account. Now compare that to leaving the cards outstanding at 22%. The spread is enormous. You are effectively replacing predatory outside debt with structured inside debt, where the interest comes back into your ecosystem instead of disappearing into a lender's income statement. That is a tremendous improvement. And I think the source is right to say the difference is not subtle. If you use a plan loan to eliminate 22% credit card interest and replace it with 4.5% paid back to yourself, you have radically changed the flow of money through your life. The same dollar that was previously enriching a bank now begins rebuilding your own balance sheet. Fay Felicite Fay Turn 63 File 0 Fay. That is the real theme of the whole piece. Same river, new dam. Now, one reason I like this tool more than most people do is that it forces them to see retirement money as capital rather than as some sacred glass box they should stare at fearfully, but never understand that matters. Because if a retirement account is large enough to lend from, then it is large enough to be part of a larger personal capital strategy. Again, that does not mean abuse it. It means understand it. And the source makes a particularly strong point for the self-employed here. A solo 401k, if properly established, can be one of the most underused financial structures in the entire landscape for small business owners. Higher contribution flexibility than many people realize. Same loan architecture if the plan allows it. Potentially much more room to let capital accumulate inside a controlled tax advantage container, and then, when appropriate, access some of that capital through a loan structure instead of through an ordinary taxable event. The source urges self-employed people to look at this immediately rather than vaguely someday, and I think that urgency is deserved. Fay Felicite Fay Turn 63 File 0 Fay. Now, all that praise requires some discipline. This is not infinite free money. The source is very clear about the constraints, and I agree with them. A 401k loan is best for shorter term capital needs, bridge financing, debt elimination, a genuine investment move with a reasonable time horizon, business startup costs under a realistic repayment schedule. It is not ideal for vague long-term fantasies that will leave you struggling to meet the 5-year repayment terms. And there is one major risk people absolutely must not ignore. If you leave the employer before the loan is repaid, the remaining balance can come due very quickly under the plan S rules. And if you cannot resolve it, the unpaid balance may be treated as a taxable distribution. That means tax and possibly penalties crash back into the picture. Fay Felicite Fay Turn 63 File 0 Fay. So again, control matters. But control without respect becomes recklessness. That is the second tool, ordinary, often ignored. Extraordinary when used with clarity. Now we arrive at the third and most structurally interesting tool related, party lending between businesses you own. This is where most people's financial thinking begins and ends much too early, because they only ever imagine two categories: borrow personally from a bank or do not borrow at all. That is not how more sophisticated operators think. If you own multiple entities, an operating business, a holding company, an asset protection LLC, a separate investment vehicle, then capital can be moved between those entities through real lending arrangements, so long as you do it properly. This is not creative fiction. It is legitimate structure. And the reason it matters is that now the interest income, the creditor protection, and the tax posture can all be shaped inside your own universe rather than outsourced. The source explains this with a very useful setup. Suppose you have a safe entity holding capital, maybe a holding LLC, maybe an entity in a protective jurisdiction. It owns money, but it has no active operations, no employees, no contracts, no day-to-day liability risk. Then you have an active entity, a development deal, a house flip business, an operating company, a risk-bearing investment arm. You do not necessarily want the safe entity to own the active risk directly. That would expose the safe capital to the operational danger. So instead, the safe entity lends money to the active entity. Now look at what happened. The active entity gets capital. The safe entity earns interest. The legal relationship is creditor to borrower, not owner to operating risk. And if the active deal fails, the safe entity has a creditor claim, often with far better standing than a casual equity owner would have. That is the point the source is making when it says you have separated the capital from the risk legally and structurally. Cite Fayturn 63 File 0 Fay. That is not a minor detail. That is advanced thinking, because once you own businesses, keeping capital safe is just as important as putting capital to work. Maybe more, so any fool can chase return. Adults care about hierarchy of claims. Adults care about who owns what, who owes what, and where the capital sits when something goes wrong. Now, because these are related parties, the IRS properly watches them, and the source is right to be emphatic here. You cannot just move money between your own entities casually and wave your hands afterward. If it is going to be a loan, then make it a real loan, a signed promissory note, an explicit principal amount, a real interest rate at or above the applicable federal rate, a repayment schedule, collateral terms, if appropriate, actual payments made on actual dates, actual bank records showing the movement. This is not a tool for sloppy people. If you lend and never collect, or call it interest but never actually behave like a lender, then the government has every reason to recharacterize the transaction into something uglier. The source warns about exactly that, and it is right to do so. Documentation is not optional here. It is the entire difference between structure and fiction. Faithfully cite Fayturn 63 File 0 Fay, but if you do it correctly, the advantages are substantial. The borrowing entity gets needed capital. The lending entity earns interest. The interest may be deductible to the borrower and income to the lender. The money never left the family ecosystem. The capital was risk, partitioned instead of sprayed everywhere indiscriminately, and the bank never inserted itself in the middle to collect the spread for existing. That is the third tool. Now the source wisely does not stop there, because once your mind is shifted into this way of seeing capital, you begin noticing other structures that live under the same general principle. One is the HELOC, the home equity line of credit. Most people think of a HELOC in one of two ways, either as a desperate emergency fund or as something vaguely dangerous best never touched. That is incomplete. A HELOC is a low-cost secured credit line against equity you already own, and if used intelligently, it becomes one more way of making trapped capital mobile. The source makes the tax point here that many people never learn. If HELOC proceeds are used for investment purposes rather than mere personal consumption, the interest may be treated differently and potentially deducted against investment income rather than framed only as ordinary mortgage style interest. That changes the effective cost and can make the facility far more attractive than households realize. File cite Fayturn 63 File 0 Fay. Now this is not a toy. It is your house. If the investment fails, the lien remains. So the risk is real. But that does not make the tool bad. It means the tool deserves respect. Again, same theme. Capital sitting still is not always efficient. Capital mobilized carelessly is dangerous. The adult game is intelligent movement. Then comes the securities, backed line of credit, the S block. This one is almost invisible to ordinary people because nobody tells them the account itself can become collateral. But once you have a meaningful portfolio at a major brokerage, the portfolio can often support a credit line. You borrow against the securities. The portfolio stays intact. You do not sell positions. You do not crystallize capital gains. You do not interrupt the investment thesis. You simply use the portfolio value to access capital at relatively attractive rates. The source explains this clearly and ties it to the behavior of larger investors who do not run to a bank committee whenever they need liquidity. They borrow against appreciating paper, deploy the cash, and leave the underlying positions in place. That is how asset-rich people stay liquid without constantly triggering taxes or destroying their long-term holdings. Fay Felicite, Fay Turn, 63 File 0 Fay. Now again, danger exists, margin call, style risk exists. If the portfolio falls hard enough, the line can become dangerous. So this is not universal medicine, but it is absolutely part of the same mental family. Do not sell unnecessarily if borrowing intelligently against a stable asset base is superior. That is what the wealthy understand almost intuitively because they think in terms of systems instead of isolated transactions. Now, I want to step back because this is the part that matters most. What are all these tools really doing? They are not tricks. I dislike that word. The moment people hear trick, they either get overexcited or over-defensive. These are structures, and every structure serves the same underlying principle. Capital is most powerful when it is circulating under your control, rather than sitting idle or leaking value to strangers at every turn. That is the deeper lesson. Every unnecessary dollar of interest you hand to a bank is a dollar that can no longer compound in your system. Every time you default to outside borrowing when inside borrowing would have been safer, cheaper, and structurally cleaner, you have voluntarily funded someone else's wealth instead of your own. Every time your cash sits dead while your debt bleeds, you are losing the spread. That is what the source wants people to feel in their bones. Money is not only about accumulation, it is about routing where it goes, who controls it, who earns on it while it moves. That is why the river and dam image is so strong. Once you see it, you start noticing the leak everywhere. Payday comes in, payments go out. Institutions clip their piece, and if you never build alternate channels, that clipping becomes your whole financial life. Now, before I leave you with only the upside, I want to be direct about the risks. Because the source is direct, and it should be, these tools can all be misused. Permanent life insurance can be badly designed and become an expensive trap if the early economics are awful and the policy is surrendered too early. A 401k loan can become a tax problem if employment changes and the balance is not handled properly related. Party lending can become a legal and tax mess if the documentation is sloppy or the payments are fictional. A HELOC can put your home into the risk chain if you pledge it against a foolish investment, a securities. Backline can produce forced liquidations in a market shock if you borrow without respecting volatility. None of that invalidates the tools. It simply means the tools are for adults. That is the only way to say it. Adults, people who document, people who model downside, people who borrow less than they theoretically can, people who care about servicing ability, not just possibility. People who understand that the best strategy in the world can still destroy you if execution is arrogant. That is why the source says proper legal, tax, and accounting support matters. It does. Not because professionals are magic, because well-built structures require precision. And precision matters most when the money starts becoming large enough that small errors compound too. Now, I want to end where the source ends because it ends with the right principle. The quality of your financial life is determined much less by income than by understanding. That may bother people because income is visible and understanding is not. But I think it is true. I have seen people with excellent incomes live like obedient serfs to financial institutions because they never understood how capital really worked. And I have seen people with less glamorous incomes steadily build control because they studied structure early, respected math, respected tax law, respected collateral, and stopped assuming every answer had to come from the institution whose profit depended on their ignorance. That is the real divide understanding. The wealthy do not have access to some secret category of money. They have access to better architecture, better tax awareness, better debt structuring, better collateral usage, better patience, better routing. That is what the source is really teaching. Not that you should hate banks. Banks have legitimate functions. Not that every person should rush out tomorrow and build every tool discussed here. That would be foolish. The real lesson is much more powerful and much more transferable. Stop letting your financial life default into someone else. S system just because you never learned how to build parts of your own. That is the whole thing. Learn enough to understand when borrowing from yourself is better than borrowing from a stranger. Learn enough to understand when an insurance policy is being built for your cash value versus for the agent's commission. Learn enough to understand when your retirement account is a trap box and when it is usable capital. Learn enough to understand when your businesses should own risk directly and when they should relate to each other as lender and borrower instead. Learn enough to understand when an asset should be sold and when it should instead support a credit line. That is real financial education, not slogans, not envy, not TikTok theater. Understanding. And once you have that, your capital begins behaving differently. Not because it became larger overnight, because it became better organized. That is how you become your own bank. Slowly, legally, structurally, by keeping more of the river inside your own dam than you did before. And when you do that long enough, the result is what all serious wealth building eventually becomes: less dependence, more control, more compounding inside your own world. That is the point, not performing sophistication, owning the infrastructure.